What do the Fed's latest enforcement actions mean for your money? And why is the focus on former bank employees a win for investors and customers? The Federal Reserve just disclosed actions involving ex-employees of Equity Bank and First State Bank of Dongola. The message is clear. Accountability doesn't end when someone leaves a job. The Fed is signaling close scrutiny of conduct that could threaten safety and soundness, consumer protection, or the integrity of bank operations. Here's the key idea. These are individual-focused actions, not penalties against the banks themselves. That matters because it targets decision-makers and gatekeepers whose choices shape risk. The tools include prohibition orders, civil money penalties, and limits on future work in banking. They are designed to protect depositors, strengthen governance, and deter misconduct across the sector. Behind the scenes, these steps often stem from supervisory exams or joint investigations with other regulators. When the Fed names a person, it usually means the role carried real responsibility at the time of the alleged conduct. That sharpens incentives inside banks. Managers invest more in controls, training, and oversight when they know accountability follows the individual. This is not about interest rates or inflation. It is about the Fed's mandate to keep the banking system safe and sound. Stable, well-governed banks support healthy lending, reliable credit, and investor confidence. When compliance is credible, tail risks shrink. Funding stays steadier. Earnings volatility eases. For banks, the signal is to tighten hiring standards, monitor higher-risk roles more closely, and escalate problems fast. For investors, strong enforcement supports risk discipline that can protect capital when stress hits. Governance quality matters as much as capital ratios when the unexpected arrives. For customers, this is about safeguarding deposits and fair treatment in everyday services. Accountability reduces the chance of unpleasant surprises. So what can you do now? If you own bank stocks or bonds, read risk disclosures with fresh eyes and assess governance. Watch for patterns in consent orders and enforcement history on regulator sites. Pay attention to turnover in compliance and risk leadership, and whether management invests in controls after findings. If you're a customer, keep balances within FDIC insurance limits, favor transparent fee policies, and value institutions with responsive complaint handling and stable leadership. Accountability is a quiet but powerful driver of financial stability. When it works, everyone benefits. Read the full article at finlitica.com.